Hello everyone, I'm Vincent and this is Resonanz Spotlight, the podcast where we explore investment strategies, learn the story behind them and meet the expert who create them. Welcome to the first episode of our private market mini-series. Today we are joined by Saâdeddine Yahia, Investment Director at Resonanz Capital, who leads the firm's illiquid credit initiatives. Together, we'll explore credit risk transfer transactions and how they transform risk management for banks, allowing them to free up capital while offering unique opportunities for investors. San, welcome back to the show.
Thanks for having me, Vincent. It's great to be here.
So, Sad, let's start with the basics. For those unfamiliar with the concept, what exactly are credit risk transfer transactions and why do they matter for banks?
Yeah, it's a great intro question. So, credit risk transfers, or CRTs, also commonly referred to as significant risk transfers, or SRTs, are mechanisms that allow banks to offload the credit risk of their loan portfolios to another party, such as an investment fund. Essentially, the bank mitigates potential losses while improving capital efficiency through CRTs.
Right. So, in doing this, banks free up capital, allowing them to lend more and support the economy. But how did CRTs evolve into such a critical tool?
Yes, sure. So CRT strategies really took off after the '08 global financial crisis. Regulatory pressures required banks to better manage their balance sheets. So CRTs provided a way not just optimize capital, but also distribute risk, making financial systems more resilient.
So, it sounds like CRTs play a huge role in reducing risk. But how do they compare to other securitized products like CLO, collateralized obligations?
Yeah, good point. Both CRTs and CLOs aim to manage risk in loan portfolios, but there are key differences. CLOs typically deal with lower rated loans and are structured into complex tranches. CRTs, on the other hand, reference higher quality loans and usually involve simpler single tranche structure.
And from an investor's perspective, how do these instruments differ in terms of risk and return?
CLOs have higher leverage and offer more potential upside, but also come with greater risk. CRTs, on the other hand, provide stable returns with lower risk due to their exposure to better quality loans.
So we've touched on the benefits for banks and investors. But Sad, let's go into the real crux. What makes CRT such a game changer in today's financial environment?
CRTs are a game changer because they allow banks to manage their capital more efficiently, which is crucial in highly regulated environments. By transferring risk, banks can lend more, supporting economic growth while keeping their balance sheets in check. So, for investors, on the other hand, it provides exposure to high quality, stable assets not usually available in public markets.
Okay, that's really interesting. But CRTs are not without their challenge, right? So what are some risk or downside that both banks and investors should be mindful of?
Of course, that's correct. While CRTs offer many benefits, they do come with certain risks, such as counterparty risks, complex regulatory environments, and liquidity challenges. Investors investors must thoroughly understand the underlying assets and the potential for defaults, even if they are dealing with higher quality loans.
Thank you, Sad, for walking us through this important financial tool. To wrap up, where do you see CRTs going in the future?
Yeah, with regulatory landscapes evolving and banks looking to optimize their capital further, I believe the role of CRTs will only grow. They are pivotal in supporting safer, more resilient banking systems while providing investors with attractive risk adjusted returns.
That sounds promising. Sad, it's been a pleasure having you on the show, and thanks for sharing your expertise.
Thank you, Vincent. It's been great discussing CRTs with you today.
That's it for today's episode of Resonance Spotlight. For more insight, visit our website and don't forget to tune in next time for another deep dive into the world of investment. Until then, stay curious and stay informed.